Hi, everyone, and welcome back to Your Finance TV. The debt ceiling crisis is over for now until 2025. But all eyes are now going to turn to data ahead of the FOMC meeting on June 13th and 14th. What can we see between now and then? Only time will tell. Break all that down with Brendan McCarty back from Column E Management. How are you, Brendan?
I'm great. How was your weekend?
It was busy with kids' sports, and you know that feeling.
Yes, indeed.
Before we kick off, don't forget to click on that subscribe and like button below. The numbers continue to grow. Thank you so much for your support. Okay, into the first segment here. OPEC's been sitting at the table yesterday and today. There was no secret that Saudi Arabia wanted higher prices for oil. Saying that, they did cut by an extra million barrels a day production in July, and they're going to evaluate after that. Previously, the Emirati energy minister said he expected the meeting outcome to balance the market. We'll see what happens from that. Brendan, where do you think we can see energy prices go from here?
So I think I've said this before when we've talked about it. But when I look at energy, I look at crude, I look at the products to drive direction. So I look at the micro to drive the macro, if you will. Gasoline right now, which is what everybody is talking about after this cut. I think Drudge called, I had looked up the OPEC news, but Drudge called them greedy Saudis or something like that. I think the story with this is more than just greed, though. I actually believe there's a lot more to this. And I think that the Saudis have been working with the Chinese, if I'm not mistaken, directly with oil sales. And I wonder if there's a fundamental drift here that China's just not buying as much oil as we think they are. The grand reopening, if you will. With that gas, if they were, gasoline wouldn't be sitting at right above 240 a level. It has turned here though. So stubborn $3 gasoline for all our drivers here in the United States remains, and it probably remain for another couple months based on the way things are looking. But sellers are sitting above, and I think that is the reason. I think the hedgers are sitting above because I don't think they see demand coming in like we all think it is. Like we see the Saudis cutting by, was it a million barrels?
Million
Billion?
barrels, yeah.
I get the millions and the billions wrong with these guys' numbers. But I would just say that cut, I think, is a direct response to what they're seeing for demand. I don't think they're coming like the way it was spun was they're out for Biden because Biden screwed them somewhere, blah blah blah. Whether he did or not, I don't think I think it's all about economics, right? It's not about politics. It's about what they see. And right now, crude is trending higher thanks to gasoline holding in above 240. That's my level I'm watching. So if it stays above 240 and starts to climb, that should keep oil prices higher. But there are a couple other factors that come into play. Obviously, the dollar, and right now the Fed. I mean, it's been a broken record on this, but money has been plentiful in the system, and that has kept assets higher. So you can go out right now. Crude has that support of easier money to buy, and it's got gasoline supporting it higher, and it finds buy right now. It's been finding buyers between 65 and 67. So the bulls are in charge right now. I would watch 240 in the wholesale market or any break of the retail market below 3. That would be an interesting argument and demand, and could confirm what I suspect OPEC is seeing as a fall in demand globally.
Well, an additional question on here for you, Brendan. There's been a lot of talk about short players in the oil space and how they're trying to force the prices lower. I did see something from Quiver Quantitative, and I do love their stuff. It comes across Instagram. They always follow all the political trades and so forth, politicians' trades, I should say. And they actually had a part about the Saudis sitting back going, listen, you can go out there and short this as much as you want. We're going to do what we want to do. And they've obviously done that here now. Do you think this results in the short players reevaluating, or they're going to stick with their theories?
I think the shorts are seeing the demand fall off. So, I mean, I think I haven't looked at earnings on the energy patch in a while, so I can't speak to demand there. But I know that rigs are falling and the pit rigs are falling. When oil rigs are falling, that argues that demand is falling. Um, the shorts are trying to crash 65. So they break through 65, you're going to see the biggest sell off in oil in years because it's fallen. That level has found support every time. It's almost as if the U.S. is sitting there with the SPR And I don't know if they are. I think they have to publicly acknowledge that if they're buying down there. But I mean, I can see why the shorts are trying to hit this because they see falling CRB. They probably see the fall in demand for the OPEC that OPEC is seeing, and I mean the economy here hasn't been exactly great. Plus, I mean it's just one of those things, I guess. So I guess I'm being a little wishy-washy, but I can see why the shorts are shorting. Does that make sense? I guess.
Yeah, yeah, no. Listen, as always, we'll see how this plays out. But talking about levels, the S&P is finally through the 4,200 level, a level that feels like it's taking forever to get through. Brendan, does this mean we're off to the races and potentially the start of a new bull market?
So on Friday, with the latest rate report, interest rate report, we talked about stocks. I guess I was trying to catch up. I don't know. We reviewed the risk markets through the view of money, complacency, and the momentum of stocks versus bonds. The trend of easy money is what's guided everything in 2023. I mean, back in October, liquidity stopped falling in October of last year. And guess what's happened? The Nasdaq's up somewhat, so like 40 some odd percent or something. It's up 20% since the Fed injected money in March. I would just say the underlying trend models prior, like we have this underlying model we call the growth model, and it turned back up in early May after turning down prior to the rate hikes starting last year. That is very similar to 2003, right before the Iraq War, where markets literally lost all its volatility and just started to rise. That's what we've seen. We've seen a dramatic drop in volatility. We've also seen a fall in the volatility of the daily range. It argues that conditions are getting better. Now, with that said, there's three things working against it. And I just mentioned it. Complacency is rising. So you saw the VIX collapse from, I don't know, 20 to 14. I think it's sub 15 right now. Our complacency models were also falling with it till Friday when the positioning changed dramatically. The investors got a little spooked. May have to do with the NASDAQ underperforming. I think it's underperforming again this morning too. The NASDAQ drove us higher because based on all the liquidity that was in the system. So the NASDAQ rose and everybody else watched and admired it. Over the last week, we've seen the S&P finally break through that 4,200 level. But I think it's because money came out of the NASDAQ and poured into the S&P, Earnings are turning, but they're not turning fast enough to argue that the bull market can sustain. So the key comes down to that. Oh, and one more thing, inflation pressures seem to be turning back up. I know the CRB has collapsed. I know that input prices have come down. I know grain prices have been in the pits. But it looks like with the money coming back into the system like they have, I think they're actually driving inflation back up. That works for some, doesn't work for all. Not the consumer, but it helped like General Mills for like 2.5 years. Going back to OPEC, I wonder if their fall off in demand is what they see, not enough to drive oil prices higher. Like I just said, while earnings aren't strong enough to drive stocks either. So there's potholes out there, but the price action is very constructive. The bulls are in control. Until these potholes come to fruition, party on, Gar. It's just like it's been bullish since the beginning of January. They've just been rising and rising and rising. And when the Fed injected that cash into the system, NASDAQ's been up 22% since the day they saved SVB. I mean, do you need any more evidence? Like earnings haven't risen. So it's been money and risk. Well, money and risk can take us a long way. There's a lot of charts out there. I don't know if you've seen it, but people are comparing this bubble of the NASDAQ to 1999.
Yeah. And
we're running a little bit faster than it, but that bubble happened. So it didn't just, so it, right now the bulls are in control and these potholes keep being pushed further and further out because the Fed doesn't have the guts to remove the money. And if they were to raise rates in June, I would get wary of stocks, but I don't think they're going to. And I think that's why stocks are moving up.
Okay. Well, you and I have been around long enough to know that bubbles burst. So
they do, but they do rise beforehand. And that's what, if this is, not to say this is 99, I was still in college, coming out of college in 99, but so I have no idea what a bubble, all I remember was Netscape Navigator being launched. That was the coolest thing ever because the internet was founded when I was in college. But the bubble just formed. It just happened. And AI is not as strong as the internet, in my opinion. So it's not the same great factor that everybody's touting it as. Personally, I think AI is sort of not that great, but is it strong enough to create a bubble? I don't know. I think the .coms are bigger from their effect than this AI is so far. So that is another key factor. But ultimately, it comes down to earnings sustaining, money staying in the system, and the Fed not screwing it up with another rate hike.
I know you just had a lot of viewers have just gone, hang on, AI is not as big as .com. Like, anyway, that's a conversation for another day.
Yeah, I've used Bard, ChatGPT. Not that we go on about AI, but I use Google's Bard. It's better than ChatGPT, yet ChatGPT gets all the play. I don't know why that is, but anyway, moving on.
There's many different conversations you can have on subjects like that. But as you said, moving on, a lot of people are going to be talking about Apple this week. Stock's near an all-time high. They've got their worldwide, the developers conference. Let's just let everyone else talk about that. Let's dig into some earnings for some companies. Signet Jewelers, they report Thursday pre-market. Their share price hasn't done much over the last 12 months, but it has traded in a healthy range of $50 to $83. Last quarter, they surprised the market and boosted their buyback, but a lot can change in a quarter. Their share price sold off last week going into these numbers. What do you think we can see, Brendan?
So I just reminded me of this report. Cage, one of their, they don't own Zale, do they?
I don't think so.
Well, so I have an old story I should share sometime on placement of diamonds in rings. I just reminded me of it. Anyway, aside from that, so this should be a really telling report on consumer discretionary spending, right? So jewels, if you have money, you spend more on that diamond. You have less money, you spend less on that diamond. As jewelers, these guys notably have benefited from rising prices of gold. So anything they sold, if they have gold in their inventory, that gold is worth more than it was last quarter. Of course, gold hasn't done well the last 2 or 3 weeks, but that's a different story. But it should be a great read on consumer discretionary spending. The first quarter looks like they see a decent drop in general on revenue this quarter. Looks like you have the big spending binge into Christmas. Then they see a drop off into the first quarter, into the second quarter. It's a momentum thing. So you see earnings start to rise, fall into Christmas. So I think we're in that lull where you don't see jewelry demand as big. But they have beat the last 3 times earnings wise. However, they've beat on lowered guidance each time. So they raised the guidance. Oh, I'm sorry, they dropped the guidance and then they beat the dropped guidance. Analysts seem to be wrong in many cases, it seems. Online is a key driver. They bought Blue Nile, I think, in 21 or 22, and that drove a lot of their sales. Their bottom line has been consistently seeing lower earnings in a way year over year. Blue Nile gave them a boost off of that because that's like people don't want to go to the jewelry store anymore. I mean, the jewelry district doesn't really exist in Boston anymore as it used to. That was a wonderful place, by the way, really cool. But aside from that, overall revenues and earnings are lower than they were at the end of 2021. I guess the surprise would be a beat and then and no guide down this time. Chart held the 65-week last week on that sell-off. So investors are perhaps waiting for another beat and guide down. I think that's what they're sort of looking for. Outright misses have not been good in this market. 3Ls, some of the 3Ls have been unbelievable in terms of just misses. I mean, Foot Locker missed and guide down and got destroyed for it. I forget what we looked at. Oh, Dollar General, they guided, right? Marvell guided up and took off. See what happens. So outright misses have not been good. So I don't think that's in the case here for these guys. I think what the market's not expecting is a beat and a guide up. And I think that's what would change the trend of the stock. Consumer spending, though, I debate if it's strong or not. I think that the employment market's mixed. Residential is not exactly doing well in real estate because there aren't anything to buy, I suppose. So consumer discretionary is sort of flatlining. So I'm guessing that if they do their beat and beat on the lower guidance and don't guide down, that will support the stock above the 65-week. If they guide down at all, I don't know if I'd want to be around based on the way they're treating stocks that have gone down lately. So this is a key report for the consumer, no doubt.
Well, talking about the consumer, the next name we're looking at is Lovesac. They report Wednesday pre-market. Their couches are customized and customizable options are incredible. We've been looking at them for something for the kids, but the stock is down 37% from the last 12 months. Is this a reflection of the consumer watching their spending or looking for fancier products? They beat earnings last quarter, and we saw the share price rally 15% last week ahead of these numbers. Brendan, should investors be taking a closer look at these earnings, or should they just sit back?
So with Love, it's interesting. They could beat or miss, and the numbers risen ahead of earnings the last 3 times, strangely enough. This has a ton of support off 20. So it's come off. The buyers have been sitting at $20 forever on this. There's been positive numbers of late for new housing. So when you buy an existing house, you move your existing furniture into your existing house. You buy a new house, you might be tempted to buy new things, right? And that's what Lovesac, I think, is turning. New home sales exist. New homes have actually been better because you can't buy in existing homes because there is no supply. Analysts have been gently guiding higher for annual revenues on Love since March. I wonder if that's just the market lifting all boats, and analysts trying not to be saying like they've been wrong forever, so they're just trying to get out of the way of or another wrong number. But those numbers are still lower than they were at the end of last year. So right now, they took all the numbers down, but they're not above 2021 levels yet. So this is one of those another beat on a lowered guidance thing. I think there's a question though. I think that possibly if these new home sales are an indication, I wonder if Lovesac actually beats. I wonder if they beat and guide up, saying people are buying these things, putting new stuff into their homes to get things moving. It'll be a very good read in terms of housing in general, if people are filling their houses with stuff. And miss again, it's discretionary. It's consumer. They have not been handled well. Like risk reward on these earnings lately has been favored to the downside if you're anything but a tech stock. So I would be wary of the downside on a miss. The market rallied into this thinking I think they're going to beat, and I think they're going to raise. I think the markets think they're going to raise as well. I think there's a turn supposedly for housing, so we'll see if that plays into this.
All right, for everyone watching, Brendan's very serious today because he even missed my punchline there of sitting back with a furniture company.
Sorry, not enough coffee in this cup.
Okay, let's move on to Docusign earnings, and they're Thursday after the close. Their share price is down 34% over the last year, and they've been known to beat estimates before. So what are we going to do with this? We're a long way removed from their giddy highs of 314 back in 2021, and earnings have decelerated in recent quarters. Brendan, what do you think we can see from this pandemic winner but facing post-pandemic struggles?
So usually when a stock bottoms, you see sellers just give up on it. Like even the shorts give up on it, the sellers give up on it, and the stock just generally falls to a low. And we saw that during every bear market. You look at earnings estimates, you can almost say the same thing. They just keep guiding this thing down and down and down. I don't think there's been an uptick in earnings expectations in ages. So the analyst community is sort of behind it, sort of giving up on it. The stock squeezed higher the last 3 weeks, I think, if I'm not mistaken. I think that was a technology drive higher more than anything, and a squeeze, not a fundamental reason. One of the interesting indicators I get for Docusign, and I always tried to find something that would show electronic demand. Well, what does the most electronic demand? Mortgage applications. And mortgage applications on the purchase side have been falling steadily forever. This stock goes up and down with mortgage applications. It's kind of fascinating. When the applications start rising, they rose right into January. Docusign followed it right up. When they started to fall in January, Docusign started to follow it lower. I know this thing also follows money as well. Money is plentiful, which is why it rallied. But the mortgage applications have been falling for the last month, so people aren't buying as many homes in the mortgages. I wonder with the recent buying, there's been an uptick. I think this you don't see it in the numbers, so I'm just sort of speculating. Either that or got spooked by the short squeeze like everybody has lately. I mean, the prime brokerage book at Goldman Sachs looks like nobody wants to short anything anymore. It's like a dangerous game to short anything. But I think Docusign rose lately on short squeeze. So I wonder if somebody sees something in terms of, applications are starting to rise somewhere. The picture is pretty ugly. So it would be a very big surprise if Docusign were to say earnings are better and we're raising guidance. That would ultimately shoot the stock way back up. But I don't think that's in the cards. Demand is just not there for this electronic docs right now. And I love this company. I think this company makes the world go round much faster. They save a tree, if you will. So the environmentalists, the ESG world love DocuSign. They're good for the environment. But right now there's just not enough demand, and it's hurting the stock. But if that mortgage report shows an uptick in purchase applications, you almost want to buy DocuSign on that alone. It's a kind of a strange indicator, but it's worked pretty well this year.
I'm just looking at the move there last week. It was actually up every single day last week, but volumes are very light compared to normal.
Yeah, I think that's shorts covering and longs not getting into it. I don't think the fundamental is this Kathy Woodstock. I think it might
Probably.
be.
I can look at that quickly.
I can't remember. If it is, then it's probably a reason nobody's buying it. But not to knock on her, I think it's been the way with her stocks. Nobody's been buying them. They'd rather short them, I guess. But it's just something. It's strictly off more. They're the bank of documents, right? When money is flowing in the financial system, banks do well. Well, when documents are flowing in the business world, DocuSign does well. And right now, that's just not happening.
Okay, well, let's move on to Love It, Like It, Leave It. And there were some volatile moves last week. You'll have to go back and check out that video to see some of the crazy moves that happened to some of the names. Brendan did very well on it. And go to what's your Column E website again, Brendan?
Column.com.
That's right. You can go there and sign up for all of his different little tidbits that come through. But we've got a whole list of names again this week. When I say a whole list, 6 names, all reporting this week, and Brendan's going to do his best in 30 seconds to whether he likes it or leaves it. Okay, let's start off with Ciena, and they report Tuesday pre-market.
I don't think I've ever liked this stock, but I like it. It's been around forever. Not much upside though, so I like it, but the upside is somewhat limited. The range is right above it. I assume if they have good earnings report, they're going to bust through that range like every tech stock has. Look at Marvell 2 weeks ago. Not much upside, but the move off the 65-week looked positive, so I like it.
Okay, one name we haven't looked at in a while is UNFI, United Natural Foods, and they report Wednesday pre-market.
So I remember us doing a food, love it, like it, leave it. UNFI was in that one, but I would leave it. This chart is downright ugly. I think the world came back to selling things at higher prices with less revenue. Finally bit them, but anyway, ugly chart. Got hammered in March. Really has not bounced back, so I'd leave it.
Okay, another one we haven't looked at in a while as well is TripAdvisor, TRIP. They report Wednesday aftermarket.
Yeah, this is another one. So we mentioned Signet as a good discretionary reading. Docusign is a good reading on the business. TripAdvisor is a good one in travel. I like it. Nice turn-off support from the pandemic lows under 16. So this is like a bear market low bounce or a turn off the lows. What do you want to say? Chart overall looks very weak, but perhaps this is a ray of hope for the bulls. So I like it.
A new one for us to look at is TTC, Toro, and they report Thursday pre-market.
Is this the ones who make Toro motors? I didn't even look.
You're just looking at the charts, buddy.
Yeah, that's right. I don't even know the hell they are. Excuse the language. Toro, I like it. Weak chart with momentum building on the sell side from the 115 highs, but the stock held the 65-week last week. If you haven't got it so far, the 65-week moving average is my favorite indicator and guides everything. So perhaps this argues some short-term strength back up towards 112. So I like it.
Okay, the next one is MTN, Vail Resorts. They report Thursday after the close.
So this one flat out kind of surprised me because ski season around here was terrible. The snow's not that good. Anyway, I like it. I wonder if this argues ski season's about to see a strong winter ahead. Maybe because it's 45 degrees here in the Northeast today and it's June 5th. I think this strength higher. So a nice bounce again off the 65-week. any stocks that generally bounce off the 65-week in a rising market tends to argue they're in a bull market. So I like it.
And the last one is a favorite of mine. Well, their product anyway, is Napa Duckhorn. They report Thursday after close as well.
So I remember when Napa, when we talked about the IPO back when we started this whole thing 2 years ago, right? And I remember putting Duckhorn in the background just so they'd see it. Just kidding. Oh no, it was Decoy. Anyway, I like the stock. Nice turn off 13 and then through the resistance at 1375. Admittedly, it doesn't have a lot of upside. The stock barely moves that much, but it looks like it wants to run to the 65-week at 1450. I know Napa's had a ton of problems with weather, so that might affect earnings to some extent, but I haven't researched enough. Chart looks okay to run to 1450.
Okay, great. Well, I actually bought a bottle of it yesterday for Maddie's birthday. So happy birthday for yesterday, Maddie.
Happy birthday, Maddie.
All right, Brendan, thank you so much for your time again today. You have a fantastic week, and we'll be talking to you again next week.
Sounds good. Have a great week, everybody.
For everyone else out there, good luck investing.